ranking the magnificent 7 stocks from the most expensive one to the cheapest one. That's what I'm going to talk about in today's video. I think this is a very, very interesting start of the year with Amazon, which was the most hated one, outperforming all the big 7. And then you have Apple and Nvidia, which have been underperforming so far. I'm going to talk about all of them today and the setup going into 2026. So I really hope you enjoy it as always. The first one is Amazon. Amazon, I mean, so far so good. The stock is finally going up, and I almost lost my patience, but I really haven't. And it's up 7% year to date. It's doing really, really well. I recently added to the stock when it dipped to 225, and I really wanted to add to Amazon before the next earnings report. The reason why I wanted to do that is there was this report from Semi Analysis that I talked about, and it mainly talks about Anthropic's second facility, which just came online a few months ago, and that's going to bring in a massive reacceleration to Amazon Web Services growth. And it did in September. He expected 18.5%. It came in at 20%. So his estimates were conservative, and the turnaround is playing out in real time. Now, the second quarter is expected 21, 23, 25%. And if the market notices that the growth and the reacceleration is permanent, and it was not just 1 or 2 quarters, then Amazon is due from a massive, massive multiple expansion. So this is why I wanted to buy a little bit more before the earnings report, and Mr. Market gave me the opportunity to do so. Amazon also has a very underrated robotics-related business where they have 1.5 million employees and they have about 1 million robots, and they have not been increasing their employee count despite the company growing so much. So they're finding more efficiencies within the company, which is why operating margins have skyrocketed from like 0.2% to about 11%. Still not too high relative to other big tech companies, but it's been getting better and it's been improving due to the robotics business, which is really, really amazing. And very recently, Amazon announced that it's going to try to take over Target and Walmart by building a Walmart-style supercenter. That's going to be the first one. And the company just keeps improving. It keeps going into many different areas, even healthcare with NVO to sell the GLP-1 pill, and they just keep on executing. And the stock has not been following this execution, and I believe it likely will this year in 2026. Now, despite the recent rally, Amazon is only trading at 15 times operating cash flow. When I talk about it, it was like 14 times. It barely got an expansion to 15 times. The stock should be trading around 20 times operating cash flow, or at least 1 time their operating cash flow growth. The company is growing in operating cash flow 23%, expected to grow 26% and 21%. I think it should be trading at least 20 times operating cash flow, and now trading at 15 times, which I believe is cheap. So I see at least a 20% annual return without a multiple expansion if it just matches operating cash flow growth. And I still believe Amazon is undervalued at this level. The second one is Meta, which is a stock that I recently started buying. The stock is still down 10% over the last 6 months, and it's not down due to the company not executing. They have been doing really, really well, but it mainly went down due to the massive CapEx spending, and they're gonna reaccelerate it even further, I believe, to $75 billion in 2026. And this is massive CapEx spending, and the market has recency bias. Whenever Mark Zuckerberg spent a lot on the metaverse and then he lost a lot of money, and the market believes that he's doing the same thing again with AI and with compute spending in general. But that couldn't be further from the truth. And this is an article from Morningstar, which is the title of the article is Why Meta Will Skyrocket 70% Despite Zuckerberg's Massive AI Spending. And it's a really good article from Morningstar. And it says AI has helped supercharge Meta's core advertising business. Meta's annualized revenue run rate from its AI advertising tools is more than $60 billion, according to the latest call. That means that Meta is already, via these AI tools, covering the incremental $60 billion in CapEx for AI build-out between 2026 and 2024. So the company's AI products are paying for the AI expansion. It's not like the company is just taking on crazy debt, although they did take on some debt for them to fund the operations, they're not seeing any results. They're seeing a lot of results, and now the operation is pretty much funding itself. So that's definitely not money that has gone down the toilet like what happened with the metaverse, and that's nothing close to what happened to the metaverse. Now, very recently, Meta has acquired an AI startup called Manus. I believe that's how you pronounce it. And Meta has a decent track record of doing acquisitions. They acquired WhatsApp for 19 billion, Oculus for 2 billion, now Manus for 2 billion, and acquired Instagram for only $1 billion. So they have a good record of doing great acquisitions. And I'm very excited to see what happens to Manus AI within the acquisition, as Manus has hit $100 million in annual run rate just 8 months after its launch. It's the fastest AI startup to do this ever. So I'm very excited to see what happens with the acquisition. Now, looking at the multiple of Meta, it's trading at about 22 times forward earnings. 22 times is not expensive at all. This is the lowest multiple of all the big seven, all the stocks I'm going to talk about today. Meta has the lowest multiple by far at 22 times forward earnings with an average of 23 times. I think this is undervalued. It's not expensive at all. Taking into consideration Meta's revenue growth, which they've been stellar. They grew 21% in revenues in 2025, expected to grow 17 and 15% in 2026 and 2027. So I believe Meta is undervalued. Maybe Amazon is still right now the most undervalued one, followed by Meta. The third one is Google. Google has had a stunning recovery. It's up 71% over the last year. I'm not going to spend too much time on Google as I'm trying to keep the video short, but Google's Gemini has been absolutely killing ChatGPT, or OpenAI, I should say. They've been taking market share like never before, and it's been doing really, really well. As they've been taking more and more market share, and it went from being an AI loser to an AI leader, which is absolutely amazing. Now, looking at Alphabet's multiple, and this is why a lot of people got mad from my latest video, because I said that I believe Google and Nvidia are somewhat maxed out. When I say maxed out, it's maxed out in terms of a multiple expansion. Google delivered amazing returns because the multiple went from 14 times to 30 times. Yes, they did grow in earnings per share. They put up great numbers, but it's trading at 30 times. So unless Google is going to get an expansion from 30 times to 60 times, I am not seeing another 70% move or 50% move on Google over the next 1 to 2 years. In fact, the company is expected to decelerate in earnings per share growth to 6% and 15%. This is largely due to the one-time benefits they got from SpaceX in 2025, which has increased earnings per share growth. But the company has been growing 35% plus for the last 2 to 3 years, and it's going to be hard to keep it up, at least on a comparable basis. So I would be betting on 15-16% growth in earnings per share for 2026 for Google, and the stock should deliver 13, 14, 15% of a return without a multiple expansion. And looking at the stock right now, I'm not willing to bet on a multiple expansion. I would like to bet that more with Amazon, with Meta, but with Google at 30 times, a lot of good things are priced in, and a lot of the best case, you could say, is somewhat priced in, and I could see 13, 14, 15% returns, excluding a multiple contraction. But it's really hard to argue that you're finding margin of safety and just a cushion in general if you're buying Google today at 31 time forward earnings. This is not trailing, this is forward earnings. The next one is Microsoft. Microsoft is finally starting to go down. It's still up 40% over the last year, but it's been, steadily going down over the last few months. And I've always been interested in owning Microsoft, but I never did because the stock was too expensive. When I talked about it last time, 2 months ago, it was trading at 30, 31 times earnings, and it should trade as high as 35 times earnings. Now it's trading at 28 times earnings. That's more fair for the company. That's much better for the company in general. And even 28 times, 29 times, I think is still relatively elevated. And Microsoft is the only one of the big seven that is expected to reaccelerate in earnings per share growth in 2026. Most of them are expecting a deceleration in growth. Microsoft is the only one that's expecting a reacceleration from 15% to 18.5%. And that's really amazing to see. Now, for my valuation model on Microsoft, this is what I have. I put in the current earnings per share of 1364. Then I just went with the estimates of 18%, 15%, and I assumed that Microsoft is going to maintain 15% from now to 2030. And I believe this is a fair bet to make. The current PE ratio is about 28 times. We kept it at 28 times. In total, I'm seeing about 70% on the upside from here. And to me, that's not enough because I like to look for at least doubles over the next 5 years. And if I want to get a double on Microsoft over the next 5 years, I would have to buy the stock around $414 per share, which is negative 13% from today's price. So for me, Microsoft, I can't really say it's overvalued. I can't say it's extremely overvalued, but I would say it's fairly valued on the absolute best case scenario. And I don't want to bet on the absolute best case scenario. And I want to take into consideration a margin of safety. I'm not going to bet on Microsoft trading at 35 times 5 years from now. It could happen. If it does, then that's a plus. But as a base case, I don't want to bet on that. So I think betting on 28, 27 times is fair. And I got low $400 as a potential buying opportunity for Microsoft. And this is where I have my price target. It's around $410 per share. Now, the next stock is Apple. Apple is starting to go down. It's down 7% over the last months. I always say that Apple is the last Mag 7 stock I would buy. Maybe Tesla is the last one, but Apple is also Apple and Tesla. And I don't really like Apple because it's also overvalued. I mean, it used to trade at 35 times, now trading at 31 times. But it's trading at 31 times with pretty much little to no growth. The company was literally declining in revenues 2.8%, and they could maybe grow 5-6% tops over the next few years in revenues. Now, they do grow earnings per share much faster, around 10 to 11%, because the company spends 100% and sometimes more than 100% of their free cash flow on buying back stock, which inflates earnings per share. And that's really good. But that's why, Apple is not driving revenue growth is because they're not spending too much on innovation. The reason why Meta is growing 20% and Google and a lot of them are growing 20, 25% is because they're innovating, finding new products, expanding into new markets. They're spending on CapEx. They're spending on innovation. They're not focused kind of Pepsi, where Pepsi can't really reinvest too much, so they just give it to shareholders. This is what Apple is doing. And most of the returns have been driven not by earnings per share growth, but mostly by a massive multiple expansion. And I'm not willing to bet on that. So for me, Apple is still not attractive over here, and I would personally avoid it. Another stock is Nvidia. Nvidia is down 2.5% year to date. That's a little bit surprising to me. Nvidia right now is trading at about 26 times earnings. I think the setup is looking interesting after the CEO has revealed their next generation chip-related products. And Nvidia is really the best kind of stock to be betting on AI because they sell shovels in the gold rush. After they put up the new product, then you have Nibius and CoreWeave and all these companies, AI data centers, they're going to have to go and buy the new ones. And every 2 to 3 years, maybe 4 years, 5 years, they're going to have to buy the new Nvidia chips every time Nvidia puts them out. And that's the best way to be betting on that. So Nvidia is an amazing company. They have an amazing CEO. 26 times earnings is really not extremely overvalued for a company that has been growing earnings per share 130%. And it's expected to keep growing 56 and 61% over the next 2 years. I don't believe Nvidia is extremely overvalued over here, but the biggest challenge with semiconductors is they're still cyclical. They have not been cyclical over the last few years, but they're still cyclical. And whenever more competition comes in, whenever the tide goes out, you could say, and they're no longer growing 50 and 60%, then Nvidia will look overvalued. But even here, if the growth is not 60%, it's 30%, and the company is trading at 26 times. That's still not expensive at all. So I don't believe Nvidia is overvalued. I think it's not bad at this price. It's really not bad at all. Now the last one is Tesla, which I don't really comment on too much because I believe Tesla is more of a futuristic bet, and I can't really predict what kind of market shares they can get from robo-taxis and their autonomous vehicles in general and the robotics business. I can't really predict that. And the stock is trading at 14 times as high as it was back in 2021. And, to me, Tesla will never be like a core position. If I ever buy Tesla, it would be, like a small position speculating on the future of innovation and a great CEO. But other than that, I don't have much to say about Tesla. But that was really my opinion on all those stocks, the big seven. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.